Welcome to the deep dive. So if you've been following high finance and deep tech at all, you know the growth in AI isn't just fast. It is astronomically capital intensive. I mean, we're talking about a technology cycle that needs infrastructure, talent, and compute power on a scale we've just never seen before. And the pace of this growth, it's completely rewriting the rules for how institutional money gets deployed. Your traditional early-stage venture round, they just can't fund the next generation of foundation models. So our mission today is to really unpack the blueprint for how global institutional money is finally starting to move into AI at this massive scale. We're diving into a highly sophisticated investment vehicle out of Luxembourg, the AI Growth Fund structured as an SCSp SICAV-RAIF. It's a mouthful, I know, but it represents the absolute cutting edge of financial engineering, and it's built to solve the specific AI capital problem.
It is, and that combination of legal and regulatory terms, it's a complete necessity. AI is scaling exponentially faster than, say, the dot-com boom or the cloud transition. It's just a different beast. You're not just funding a software team anymore. No, you're funding a digital factory. And that requires institutional capital with not only a long investment horizon, because the R&D can take years, but also deeply embedded institutional-grade governance. This vehicle gives you patient, structured money, but it keeps the agility you need.
The agility to capture deals that can close overnight.
Exactly.
And the sources we've looked at, they really hammer home that speed problem. These high-value opportunities, like a huge data center contract or acquiring a key data provider, they can appear and close in, what, a matter of days?
Sometimes less.
So how does this complex legal structure, which on the surface sounds slow and bureaucratic, actually keep up with that kind of pace?
Well, that is the paradox we're here to solve. And the answer is actually baked into the structure itself. But first, I think we really need to understand the scale of the capital challenge we're talking about.
Let's start right there. Section 1, the AI funding gap.
Okay, so let's define the capital needs of these modern AI companies. They are, frankly, unlike almost anything built in the last 20 years. We're talking about firms developing their own foundation models or building industrial automation platforms or designing, specialized AI chips.
And their cost structure is just dominated by three things that, frankly, early-stage investors usually run away from: securing massive amounts of compute power, sustaining these incredibly long and expensive R&D periods before you even see $1 of revenue, and building a truly global go-to-market infrastructure right from day one.
Precisely. I mean, when you look at the cost just to train a state-of-the-art large language model, the bills for GPUs, for data, for cooling, they can run into the hundreds of millions. These companies need funding to sustain years of negative cash flow just to compete for talent and for that computational supremacy.
So traditional venture financing, with its neat little tranches and short horizons, just breaks down.
It becomes insufficient very quickly. It's too rigid. What you need is something called structured growth capital. It's money that has the characteristics of private equity. It provides stability, strategic backing, not just a check.
And we are definitely seeing this acceleration of AI unicorns. Companies hitting billion-dollar valuations in record time, often way before they have any meaningful revenue.
Right, because the market is rewarding their engineering capability and their defensible data moats almost instantly. And once they hit that stage, let's say they've proven their model works, they aren't just looking for cash anymore, they're looking for strategic partners, someone who can help them navigate being a global, high-stakes tech provider.
So things like global compliance, board-level representation, fiduciary governance.
Especially if they're selling into regulated sectors like finance or defense, absolutely.
So if the old VC model is failing, what is this SCSp SICAV-RAIF structure actually doing to fix that?
It creates a vehicle that's robust enough to handle all that complexity. It lets investors combine growth equity, complex structured instruments, and, this is crucial, selective real asset exposure, like investing in the actual data centers, all inside one coherent strategy. It's designed for a company that is somehow both a high-growth startup and a critical piece of global infrastructure at the same time.
Okay, let's unpack that structure then, piece by piece. Starting with what you might call the governance engine, the SCSP, the Special Limited Partnership. We need to go beyond just the definition and get into why this particular legal chassis gives you the contractual freedom that these AI deals demand.
Okay. Think of the SCSP not as a formal corporation, but more like a highly sophisticated handshake agreement. It's a Luxembourg partnership, introduced under the AIFM framework. And the key part is that it operates as a contractual vehicle without a separate legal personality. It's very similar to the Anglo-Saxon limited partnership model that PE and VC managers know so well.
So for you listening, the important thing isn't the legal term no legal personality.
Yeah.
It's what that implies about flexibility.
Right. Precisely. Because it's contractual, it all revolves around that classic GPLP relationship. You have the general partner who manages the fund and has unlimited liability. And you have the limited partners who commit the capital, and their liability is strictly limited to their investment. That's standard private equity stuff.
But here is where it gets really interesting for AI, especially with global capital raising. You're trying to get money from sovereign wealth funds, European pension funds, North American endowments. They all have wildly different tax and regulatory needs.
And that is its superpower. The SCSP is treated as fiscally transparent in many jurisdictions, so it avoids those extra layers of taxation, which can be a huge hurdle. The profits and losses, they just flow directly through to the limited partners. They then handle their own tax obligations back in their home country. That efficiency is critical for the scale of capital AI needs.
Okay, but let's bring it back to the deals themselves. The main advantage is the incredible flexibility of the limited partnership agreement, the LPA. You called it the engine of contractual freedom. Can you give us a concrete example? An AI scenario where this flexibility is absolutely critical and a standard corporate fund would just fail.
Sure. AI deals are rarely clean equity purchases. Imagine an AI company that does predictive maintenance for industrial machinery. An investor might want to structure a deal where the second capital tranche isn't based on time, but on hitting a very specific performance metric.
Like what?
Like, say, reducing model inference latency by 40% in a live factory environment, or securing a key strategic data partnership in Germany. The LPA in an SCSP can define those staged commitments, the distribution waterfalls, the co-investment rights, all around these granular performance-linked metrics. A rigid corporate vehicle just struggles with things like revenue-linked warrants or earnouts based on tech milestones. The SCSP handles it seamlessly because the LPA is supreme.
So the SCSP gives us that contractual freedom and tax transparency for global investors. Now let's connect it to the second part, the SICAV-RAIF. This combination is all about speed and institutional oversight.
That's right. The RIF, the Reserved Alternative Investment Fund, is the real regulatory innovation here. It combines the variable capital structure of a SICAV with the regulatory efficiency of the RAIF regime.
Okay, and this is where we get back to that speed requirement. The common critique is that speed usually means you sacrifice rigor. How does the RAIF stay fast, but also maintain institutional standards?
That's the clever bit. The RAIF is not directly supervised by the CSSF, that's Luxembourg's financial regulator.
And that's the source of the speed.
That's the source of the speed. But instead of just being unregulated, the RAIF is placed under the legal oversight of an authorized AIFM, an alternative investment fund manager.
Okay, I see.
And that AIFM is already a regulated entity. It's already applying the full AIFMD governance and risk framework. So you get immediate launch capability. We're talking weeks, not months, which is vital for an AI fund. But you don't lose the institutional-grade risk management that a pension fund demands. You're relying on the manager's professional liability, not the regulator's upfront vetting.
That makes a lot of sense.
Yeah.
So the institutional comfort comes from the manager, not from the regulator signing off on the fund itself. And then the SECAV element adds the variable capital mechanics.
Yes. And that variable capital structure just means that when a large investor commits a new tranche of money, it's reflected directly in the fund's capital. You don't need formal, slow, statutory share capital amendments. It makes the funding so much more adaptable.
So let's link this directly to an AI financing event. Why is that variable capital so important?
Because AI deal flow is volatile. It's driven by strategic choke points. Suppose an AI company suddenly gets an allocation for 1,000 state-of-the-art GPUs. That is a massive competitive advantage.
And you have to pay for it immediately.
Immediately. You can't wait for a formal 3-month closing period. The SICAV-RAIF lets the manager align capital calls with these specific, irregular, and often urgent events. Scaling a model, commissioning a data center, acquiring a strategic team. The speed of the RAF and the flexibility of the SICAV means the fund can act decisively when the AI market demands it.
Okay, so just to summarize the synergy here, the combined SCSP SICAV-RAIF structure gives investors a really clear path. It blends regulatory clarity, speed through that AIFM oversight, and the contractual freedom you need for these complex, fast AI deals, all in a tax-transparent package.
Precisely. And this is all becoming so necessary because the investment focus itself is fundamentally changing.
Which brings us to our final strategic area, investment horizons and risk management. We need to talk about AI infrastructure as a core asset class.
That shift is profound. Data centers designed just for AI workloads, huge GPU clusters, specialized semiconductor facilities. These are enormous capital projects. They require long-term planning, multi-year construction, massive utility contracts. They look and feel a lot more like traditional infrastructure and real assets than software.
Yeah, and the flexibility of the SCSP is what lets the fund bridge these different asset types.
Absolutely. The SCSp SICAV-RAIF structure allows the fund to be a hybrid. It can hold normal equity stakes in AI software companies, but it can also hold project-level investments in data centers or sale and leaseback deals for hardware or even JVs for compute infrastructure. This creates a really powerful diversified exposure across the whole AI value chain, from the silicon all the way up to the application layer.
But investing in technology, this fundamental, must introduce a unique set of non-traditional risks. I mean, we're way beyond simple market volatility here.
Oh, that's the challenge. The manager has to explicitly manage what we call algorithmic risks and regulatory risks. On the algorithmic side, you're looking at things like model reliability, model drift, where its performance just degrades over time, and the inherent quality and bias of the training data.
And on the legal and IP side, it gets even messier, especially with AI-generated outputs.
It does. IP ownership in AI is incredibly complex, especially when models are trained on diverse global data sets. The AIFM has to stress test IP claims across different jurisdictions. And then the regulatory landscape is completely fragmented. You have the EU AI Act setting one standard, the US taking a different approach. The fund has to manage all of that fragmentation.
So how does the AIFM, the core oversight body, practically manage these specialized structural risks?
The AIFM is absolutely central to risk mitigation. They have to establish robust, independent valuation methods, which is incredibly hard for a pre-revenue AI unicorn. They have to monitor leverage. They have to run detailed scenario analyses. For instance, what happens if Google or OpenAI releases a model that basically commoditizes your portfolio company's entire business overnight?
A very real risk.
A very real risk. And critically, they assess concentration risk, not just financial concentration, but reliance on one specific data set or a single type of GPU. Because the fund is a RAIF, this robust risk framework isn't optional. It's embedded in the fund's day-to-day governance, which provides huge reassurance to institutional capital. It's the logic of private equity, but applied to the unique volatility of AI.
This has been a fascinating breakdown of some pretty serious financial infrastructure. So let's synthesize this for everyone listening. What's the biggest takeaway here? Why is this specific structure becoming the default choice for deep-pocketed AI investors?
The key takeaway is that the SCSp SICAV-RAIF structure is a synthesis. It isn't a compromise. It combines the launch agility and speed of the RAIF regime, which lets you capture those urgent opportunities, with the deep contractual flexibility of the SCSP partnership model, which lets you structure those complex hybrid deals.
So you get the best of both worlds.
You really do. And by offering this scalable, jurisdictionally robust vehicle, Luxembourg is effectively positioning itself as the global capital hub for sophisticated AI growth investing. And this is significant because as AI gets integrated into critical global infrastructure, into financial markets, the vehicle used to fund it has to be just as resilient and clear and capable of handling those huge cross-border institutional commitments.
So a final thought for you to take away. If the future of technology really is decided by scale and speed, as this entire investment model suggests, what does the rise of these massive, highly tailored institutional funding vehicles mean for the AI ecosystem? Does it signal a necessary evolution, acknowledging that only big money can fund the next generation of foundational models? Or does it signal a huge consolidation of power and resources, maybe even the end of that traditional nimble startup ecosystem that drove all the earlier tech cycles? Something for you to ponder as this AI decade continues to reshape our financial and technological world.